Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. Okay, folks, it is November 2nd. Happy FOMC Day, Federal Open Market Committee Day. And Chair Jerome Powell and the gang at the Federal Reserve pretty much acted as expected. On Twitter, I gave a 75 to 85% chance of a 75 basis point hike, and that's just what happened. This puts us in the territory of the most intense hiking schedule in 40 years. And in their statement announcing the rate hike, they're not showing any signs of slowing down. They said, quote, "The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time." So, not only did the committee not slow down the rate hikes, that day seems far off, because the committee voted unanimously for that 0.75%. So, going from Chair Powell at the Federal Reserve, let's take a look at what Chair Gensler at the Securities Exchange Commission has been up to lately. He was speaking at the Practicing Law Institute's annual Institute on Securities Regulation today when he brought up a number of enforcement actions that have been taken against crypto firms. And he's using that to say that these are the economic realities of securities regulation. And it was in his written remarks that he brought up the actions against BlockFi and against a former Coinbase employee. I'm going to get to that one in a minute. He said that they were examples that justify his agency's actions on securities laws violations. Gensler said that the SEC was taking a treat-like causes alike approach, treating cases the same, regardless of the form that those securities take. He said, quote, "When BlockFi failed to register the offers and sales of a crypto lending product and made materially false and misleading statement about those securities, well, we charged them. When a former Coinbase manager and others allegedly misappropriated confidential information to purchase crypto asset securities, we charged them." So Gensler said that his enforcement team consisted of public servants as well as cops on the beat. He said that they were, quote, "uniting public zeal with unusual capacity." Now, Gensler said that the SEC has filed more than 700 enforcement actions as of September 30th. Those 700 actions resulted in more than $4 billion in civil penalties out of $6.4 billion collected from judgments and orders. One thing we've heard out of Gensler before was his "come in and talk to us" line. He says that he wants firms that offer financial products to come in and, quote, "cooperate with the SEC's investigation and remediate their misconduct," which is an interesting way of characterizing that kind of meeting. In part because when companies have gone and visited with Gensler and his staff, they got hit with enforcement actions, whereas other companies just simply stopped what they were doing and then they never got charged. And let's consider Coinbase's actions, because the SEC is taking action against a former Coinbase employee. And remember, this was when Coinbase brought the feds in. There was some insider trading going on, and Coinbase contacted the feds, specifically the Justice Department. Well, the SEC decided to invite themselves to tag along. This guy was a product manager at Coinbase, and he would tip off his brother and their friend about what coins were going to be listed on Coinbase. And then they would buy up those coins, and once they were listed, they sold the coins. Now, the Justice Department did their investigation, and they're in the middle of doing their own thing. However, like I said, the SEC has decided that they needed to be involved in all this. So they decided to take the opportunity to declare 9 tokens were securities. And now they're going after that employee for securities violations because they labeled those 9 tokens as, quote, "crypto asset securities." So now that puts Coinbase in jeopardy. After they opened their door to the feds, after they warned them that some scumbaggery was afoot, after being good citizens and warning the cops of evildoers, Gensler and his team are engaging in regulation by enforcement. And it's kind of sneaky how they're doing it, right? There's been no ruling. No law has been passed. No precedent has been set. In fact, that's what the whole XRP versus SEC suit is about, in part. Now, Gensler is just determining that these tokens are crypto asset securities just because he says so, and now he's going to punish people for selling them. This does not appear to be changing anytime soon. Look at the budget they put out about 6 months ago. They're planning on pursuing crypto-related securities violations well into next year. Crypto is one of those things that Gensler used to justify his fiscal year 2023 budget. So we can probably expect more of the same from SEC Chair Gensler and the boys. That is, unless the midterm elections shake things up more than expected. And these midterms are important. I'm not here to tell you who to vote for. There are a million of podcasts out there that will be happy to tell you exactly who to vote for. One side is good, one side is evil, and it eats babies. I'm not here for that. I am here because I'm interested in talking about things that affect crypto. And it seems like this next set of midterm elections might well do that. Because we've seen so far that U.S. regulators just are not stepping up. They're not offering reasonable guidelines for crypto companies to abide by. They're waiting for Congress to act. And then, once a bill is passed, once something has been signed by the president, then they're going to get to work. Now, speaking of getting to work, Switzerland is enacting some tougher ID laws, specifically where crypto is involved. They're making it harder to transact anonymously by requiring ID checks if the total transactions exceed 1,000 Swiss francs per month, which is about $1,000 US. FINMA is their Financial Market Supervisory Authority. And in a report put out by FINMA, they said, quote, virtual currencies are often used as a payment instrument for illicit trade, notably in drug trafficking, on the darknet, or for the payment of ransoms after cyber attacks. The risk of money laundering in the domain of virtual currency is reinforced by potential anonymity and by the speed and cross-border nature of transactions. Now, for the uninitiated, there's something called smurfing. Now, smurfing is where you break up a large payment into smaller payments to get around money laundering checks. Now, last May, FINMA put out a proposal on how to tighten up their system against smurfing. Now, they're going to back off on that because they've been hearing some feedback from both the crypto companies and private citizens. There was some criticism that the rules weren't technology agnostic and that all of those stores of consumer data would be big, fat, juicy targets for hackers. Now, FINMA is holding fast. There have been calls to bump up their 1,000 franc limit up to 25,000. That said, they did concede that these new rules will only apply for anonymous transactions like through a crypto ATM. But Switzerland news does not stop there, because they're part of something called Project Mariana, along with the nations of France and Singapore. Project Mariana is being coordinated by the Innovation Hub of the Bank for International Settlements. And this project is to determine whether these newfangled DeFi protocols are a good match for replacing traditional ways of matching buyers and sellers of fiat currency, which seems feasible to me. DeFi's already done that. So, for the Bank of International Settlements, they put out a statement on their website saying, quote, DeFi and its applications have the potential to become systemically important parts of the financial ecosystem. And that technology that they're looking to use here is the automatic market makers, right? AMMs. What automatic market makers do is a couple of things. They store liquidity, which is why they get hacked. And they also use algorithms to determine the price between two tokenized assets. That said, AMMs can become, quote, the basis for a new generation of financial infrastructure. Now, this Mariana project with France, Switzerland, and Singapore is just the latest in a series of events that the BIS has put together. The idea is to take a look at these sovereign-issued digital currencies like CDBCs and see whether they have use in both financial markets between nations and consumer usage in a grocery store. And so this project is interesting to me because one study last December put out by the BIS called DeFi an Illusion Now, this study said that centralized governance is inevitable. Now, I think the real problem is they're not sure how to go about regulating DeFi. In the meantime, we were just talking about Singapore, and let's stick with them for a bit here, because Singapore has been busy lately. And if it seems like we've been talking about them a lot lately, well, we have. But there's a good reason for it. They are right in the middle of their FinTech Expo. So we should be expecting lots of announcements like these. The first of these is really a pair of tests that are going to be carried out to test the usefulness of tokens in trade finance and wealth management. So 2 different projects. The first one is around trade finance, and it's being led by Standard Chartered. The second one, concerning wealth management, involves HSBC, MarketNode, and Temasek. Kai Fair is the global head of trade and working capital at Standard Chartered. They said, quote, "By transforming trade assets into transferable instruments, we aim to improve the accessibility to an asset class, which has been largely the domain of banks, with participation from a broader range of investors." He continued, "Not only can we potentially narrow the $1.7 trillion global trade finance gap, this also offers investors the option to balance their portfolio with a digital token that has traceable intrinsic value." The Singaporean central bank announced their first trades using tokenized versions of the yen and the Singapore dollar. This was actually the start of a project meant to test something that we were just talking about, using DeFi techniques but storing the financial activities on the blockchain rather than a third party, which is how they do it in the wholesale funding market, which are used by banks to maintain liquidity. Han Kui Guan is the group head of strategy and planning at Singapore's DBS Bank. He was just talking about how TradFi banks can use DeFi principles. Quote, "We wanted to show it was possible to tokenize government securities and cash within a DeFi liquidity pool. Then, using an AMM and solving for that with price oracles and market data streaming services from Bloomberg or Refinitiv, we wanted to create an institutional-grade DeFi venue which regulators would be comfortable with." In the meantime, Singapore has been looking at stablecoins too, which makes sense given how important the stables are for DeFi. Singapore's central bank has greenlit a couple of new players in the stablecoin space. Circle, producer of the USDC stablecoin, is one of those companies. Their major payments institution license allows them to offer cross-border as well as domestic payment services. In addition, they can offer tokenized products. Dante Disparte is Circle's chief strategic officer. He said that this license is important to the company because it allows them to, quote, "demonstrate the potential of digital currencies and open payment systems." Whereas Circle CEO Jeremy Allaire said, quote, "We are honored to receive the in-principle license, and we look forward to more collaborations with MAS to support the thriving crypto and blockchain ecosystem, as well as the advancement of fintech innovation in Singapore." Meanwhile, on the same day, Paxos also got permission from the central bank to operate in Singapore. Now, Paxos is the issuer of the USDP stablecoin, and much like Circle, they can now offer crypto products and services under the Payments Services Act. The Payments Services Act was first passed in 2019, and it allows the monetary authority to regulate payment systems and providers in the city-state. This includes crypto companies. In an announcement, Paxos said that their new license would let them offer digital asset products and services to companies headquartered in the area. Rich Tao is the CEO of Paxos Asia. He said, quote, "From the start, we've been committed to innovating within regulatory frameworks. We believe blockchain and digital assets will revolutionize finance for everyone around the world. But development of this technology must have clear oversight and consumer protections." This comes not too long after we reported here that Singapore's central bank was proposing new stablecoin rules, including reserve requirements and a ban on lending. These proposals are open to public comment through next month. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.